And I'm a senior lecturer in economics at Bangor University. So before we begin, I will share my slides. Right, I hope you can all see the slides there. So I'm going to start with something simple. Everything we're going to talk about today affects your money, even if you've never thought about it before. So this is not going to be a maths lesson. You don't need to remember formulas. This is about the choices people make every day. So today is about one question, one simple question that keeps me as an economist and several others up late at night. And that question is, how does one decision made in London affect millions of people across the UK, whether they're people that live in homes or people that own their own businesses, people that work for other businesses? That one decision that affects them all. So by the end of this session, you'll be able to answer that question. And more importantly, you'll understand how it affects you. Now, I'm not going to explain anything yet. I want to start with what you think. So there's no right or wrong answer at this point, just your instinct. So let's start with this. Let's see if we can go to the Padlet. Okay, so I'm interested in your initial thinking here when you hear the term interest rates. So when the Bank of England changes interest rates, what do you think actually changes in real life? What gets more expensive? What gets cheaper? What becomes harder? There's no right or wrong answer here. It's just what you think. So I hope you all have access to the Padlet. I think that the link has been shared. So what are your initial thoughts if you want to put them down in that warm-up there? All I want you to do is type one thing you think changes when interest rates go up. One idea, that's it. I see a few people typing. It's a bit to think about here, but again, just some initial thoughts on what you think. So I can see some very clear answers coming through, which is absolutely fantastic for me because it shows the confidence and understanding that people already have. So we've seen some people say savers benefit more, quite a few saving savers. Let's have a look who else is there. There's an increase in the incentive to save. So we've seen already this understanding that when interest rates go up, savers will benefit. Okay, so let's. So feel free to continue adding to that board as we talk. So let me give it in very simple terms then. So this slide gives you the whole topic in 3 ideas. So first of all, interest rates are the cost of borrowing money. It's the same as borrowing or getting anything else. There is a cost associated with that. And for us, when we're borrowing money, whether that's to borrow to buy a house, to buy a phone, to buy a car, there is a cost associated with that borrowing, and the interest rates reflects that. The interest rates as well is a tool used to manage inflation. So I'm sure you've all heard about the term inflation or seeing the changes in prices, maybe when you're going to the shop to buy chocolate. If you think about how the price has increased compared to a year ago, well, that's the inflation. And interest rates is the one tool that the central bank or the Bank of England has to control inflation. I remember talking with an economist from the Bank of England about using interest rates to control inflation. And one way to think about it is that you're trying to control this massive jumbo jet with just one small lever. And that's in effect what the central bank is doing. It's controlling inflation, this huge jumbo jet, with just one small lever, the interest rates. And like many of you have already alluded to, the interest rate is also a reward for saving. So the interest rates reflect what you get back if you save money. So as somebody already mentioned, there is that increase in incentive to save. If interest rates go up, then you want to save more in order to get more return for your money. So everything we do today comes back to these 3 ideas. Right, so a question, have rates gone up recently? Now, think about the real world. Let's think about everyday occurrences and what's happening. So have interest rates gone up, down, or stayed the same recently? I don't know if we're able to get some comments in the chat rooms about interest rates. But if we think back over the past few years, interest rates went up quite sharply. If we think back to the COVID pandemic and the increasing cost of living that came after that, the central bank trying to control inflation or the cost of living would have increased interest rates to try and bring down the cost of living. So going back a few years, interest rates shot up sharply, and they have been coming down, which of course is good news for borrowers, not so much for savers, but interest rates have been coming down, and they've recently stayed at the same levels. So you've probably seen this in the news. If there was a decision made by the Bank of England last week on what to do with interest rates, were they going to cut interest rates? Were they going to keep it the same, or were they going to increase it? And the decision they took last week was to keep it the same, given the uncertainty that's happening around the world at the moment. Maybe you've heard some family members talk about interest rates because, when the Bank of England meet to decide what to do with interest rates, they can have a big impact on mortgages that family have. So most people that own their own home, they will have a mortgage, and that mortgage, how much they have to repay every month, will depend on the interest rate. So this isn't theory, this is happening right now. So interest rates are not random. They are policy choices. They are set deliberately with that sole purpose of managing inflation. So again, if you were to plot a graph of UK inflation and plot a graph then of interest rates, you would find a very strong relationship there, that when inflation is high, interest rates would then also increase to try and bring down inflation. And when inflation is low, you tend to see interest rates low as well. So the central bank manages this, and I'll talk a bit more about central bank in a moment. But these decisions, while they are made to control inflation, they will shape your decision. Consider a situation where you wanted to borrow money. Would you be more willing to borrow money if you knew the rate was 20% or if it was only 5%? So these are decisions that really have an impact on you. So you heard me mention a bit about what is about a central bank. So let's really delve into what is a central bank. So who's making that decision? So a central bank runs monetary policy. So this is not policy regarding taxes or government spending. It's primarily to do with the value of money. And the key tool to do that is with interest rates. So the central bank, it controls interest rates. It also keeps the financial system stable. So if we think about all the banks there are in the UK, the building societies, the credit unions, some of you might have online banks like Revolut or Monzo. The central bank is responsible for those institutions, those banks. And the primary objective is to keep everything stable so it can control inflation. So in the UK, we have the Bank of England. So the Bank of England was established a very long time ago, and given that I'm being put on the spot, I can't remember the exact year, but I wouldn't be surprised if it was around 1600s. So this is an institution that has been with us for a very long time. So a group within the Bank of England, a group called the Monetary Policy Committee, or MPC for short, meets regular, about usually 8 times a year, but they can meet more often if required. And what the Monetary Policy Committee does is decide what should happen with interest rates. And their goal is simple: keep inflation low and stable. There are other central banks across the world. So if we think about the Eurozone, we'd have the European Central Bank. In the United States, we'd have the Federal Reserve deciding on the interest rates. One thing to remember is that all the central banks would have different objectives. So, for example, the Federal Reserve in the United States has the objective of keeping inflation low, but also to grow the economy. But here in the UK, the Bank of England's goal is fairly simple: keep inflation low and stable. So they're trying, by doing this, they're trying to keep the economy steady. So a quick question, is the Bank of England part of the government? Again, feel free to put your thoughts in the chat box. The answer is that it works with the government, but it is independent. The Bank of England did used to be part of the government, but over time, economists realized that central banks were better able to do their job if they were independent from the government. If you thought of a situation where a central bank was part of the government and there was an election coming up, then it would be beneficial for the party in power if the central bank would cut interest rates so that people were able to borrow more cheaply and felt better, and therefore would more likely vote for the party in power. But economists wanted to get over that problem. They wanted the central bank to focus on controlling inflation only, and that politicians could not interfere with the decisions made by central banks. So it was decided that the Bank of England and many other central banks should be independent from the government. You could ask the question, why is this decision made at a UK level, not Wales? So in Wales, we always hear about devolved powers that the Senate have on income tax, for example, or stamp duty. These are all devolved taxes and decisions that the Welsh Government can make. Also on education, the decisions made around educations are devolved to the Welsh Government. But with interest rates, this continues to be a whole UK decision and not just about Wales. There are several reasons for this. First of all, there's only one central bank, and it is the central bank that decides on the interest rate. So a central bank for the whole of the UK. There's only one currency, the sterling or the British pound, for the whole of the UK, whether they are in Wales, Scotland, Northern Ireland, or in England. We all use the same currency. And that currency, the value of that currency, is controlled by the interest rate. And then finally, it is just one financial system. The banks that we see on the high street here in Wales are also the same banks that we see across the rest of the UK, whether you're walking down the high street in London, Birmingham, Cardiff, or here in Bangor, you tend to see the same banks. So it's that one financial system that needs to be managed by the central bank. So you can't have different interest rates in different parts of the same country if it's all using the same currency and has that one financial system. So what is an interest rate? So let's define it clearly. And it was great to see some of the comments that some of you had earlier on this morning. So an interest rate is the cost of borrowing money or the reward for saving. So if you are saving money, whether that's in a savings account or any other type of account that earns interest, you earn interest on that money. If you borrow money, you pay interest. It's the cost of borrowing money. So let's consider a very simple example. So let's imagine that you borrow £100 and the interest rate is 5%. You would therefore add that 5% onto top of the 100. So 5% of £100 is £5. So adding that £5 on top of the £100 that you borrow, so you repay £105. So that extra £5 is the cost of borrowing. Now, this is where it gets interesting. So, as we've seen, borrowers pay more when rates go up. So, if we think about the previous example that we had here, if you wanted to borrow £100, but the interest rate was 10%, how much would you be repaying at the end? I'll let you think about that. So if we were to borrow £100 this time and interest rates were 10%, how much would you be paying back? So again, if we think of the calculations that we performed earlier, so if we borrow £100, interest rates were 10%, so 10% of £100 is £10. So we would need to repay £110. So if interest rates are going up, we need to pay more back. So again, this is where it becomes interesting. So borrowers pay more when rates go up, but when rates go up, savers earn more on their money. So if you have savings, you can see your savings going up because you're earning more interest. So the same interest rate has completely different effects. So if you imagine you have £100 in your savings and the interest rate is set at 10%, then the amount that you would get on your saving is 10% multiplied by £100, and that would give you that £10 return on your savings. So the same interest rate has completely different effects whether you're borrowing or if you're saving. So feel free to do this exercise in your workbook as well. So imagine you're 18 and you have £1,000. You have two different options. So you could save it. Option A, save it in a bank account and earn interest. Or option B, you could borrow more money, perhaps another £1,000 to buy a car or a laptop. So I want you to decide. I want you to take a few minutes to think about this. What would you do? And more importantly, why? So you're 18, you have £1,000. Do you save it or do you borrow more money and spend it buying a car or a laptop? Think about how you would make that choice and why. So you have £1,000, two options: save it in a bank account and earn interest, or borrow more money to buy a car or a laptop. Just think what you would do, and more importantly, why. Okay, so let's explore this idea further then. So when interest rates are low, who benefits? When interest rates are low, borrowers benefit because if we think about the previous examples that we've spoken about, so if we imagine that situation where we were borrowing £100, and when interest rates were 5%, borrowing cost was £5, so we had to repay back £105. When interest rates increased to 10%, so our borrowing cost increased from £5 to £10, and the amount that we had to repay back was £110. So when interest rates are low, borrowers benefit. So loans are cheaper, whether that's if you're borrowing to pay for a car, or to buy a laptop, or if you're buying a house, borrowing money to buy a house. But when interest rates are low, savers lose out. So the returns are lower. So if we think about if you had £100 to save and interest rates were £5, then your return were 5%. So your returns are going to be £5. When interest rates increase to 10%, your return on that £100 was £10. So returns were higher when interest rates were higher. So when interest rates are low, savers lose out. What about the opposite when interest rates are high? So when interest rates are high, again, if we think about the simple calculations that we've performed, so when interest rates are high, savers benefit because they earn more on their savings. But on the flip side, borrowers lose out because borrowers feel the squeeze, loans become more expensive. As people are commenting on the Padlet, there's a great comment there. I wouldn't save when interest rates are low because I won't gain much from it and I benefit from spending it. And this is one of the key ideas that the central bank is trying to control. So when interest rates are low, so when inflation is low, they're trying to encourage people to get the money circulating in the economy. So by having interest rates low, there's no benefit to saving. So people tend to take their money and spend it in the economy. Another comment there, a great comment. So when interest rates are low, they would borrow more, as there'd be a lower price to add onto it. Another, if we think about the decisions that businesses make when they need to borrow money to invest in new machinery, when interest rates are low, well, the cost of borrowing money to buy that machine then are low, and the returns that they could make from using that machine could be higher. And so this interest rate decision has a big impact on the returns that they make. Let's remember, while we've focused on low interest rates there, the other flip side of the coin is high interest rates. And you can imagine the reverse effect there. Again, please feel free to put any comments that you have on the Padlet as we walk through this slide. So why do they want this? Why does the central bank want to change interest rates at all? Would it not be easier for everybody if there'd be one interest rate, perhaps for the whole year or for maybe 10 years? So rather than changing interest rates on a regular basis, that they set one interest rate and that's it. Everybody would then know where they stand, whether you're borrowing money or savings. So why change at all? Well, the key reason is that they are looking to control inflation. And as we've seen, inflation, or the price of goods and services that we do buy, tend to change on a regular basis. If we think about energy costs, so energy prices feed into inflation, and we've seen a sudden spike in energy costs, and so the central bank needs to respond to that by changing interest rates. It also needs to control or change interest rates to influence how people are spending money. As somebody already comments, if interest rates are low, they wouldn't save their money because the rate of return that they'd get is quite low. So they would spend it, which is what most people would do. But the central bank, or the Bank of England, is also aware that if people spend too much money, if they use all their savings and spend it, then inflation could get out of control. And therefore, there might become a time when interest rates have been low and people are spending their savings, that the central bank decides this is beginning to have a negative impact on inflation, so we need to increase rates in order to encourage people to start saving more. And so by doing this, they're able to keep the economy stable. So let's bring it all together. So again, feel free to put your comments on the Padlet of who benefits, but when rates rises, savers win, whether you're saving in a savings account or different financial products. When rates rises, savers win, borrowers lose. When rates fall, borrowers win, savers lose. So there are three things to take away from today. So interest rates are a policy choice. They're deliberately set by the Bank of England. They're not random decisions, but they are policy choices there to control inflation. So they're used, interest rates are used to manage inflation and ensure the economy is stable. They manage inflation by increasing or decreasing the cost of borrowing, and also increasing and decreasing the incentive for savers, whether to save more or to spend their savings. And the main thing to remember is that while this is a decision made in London, and I'm sure if anybody here goes on to study economics, you'll be studying interest rates in far greater detail. Interest rates affect real decisions in your life. So one final question, and again, I'd be interested to hear your thoughts in the Padlet. So do higher interest rates always make life harder for everyone? Let's see what you think. Put your thoughts in the Padlet. Do higher interest rates always make life harder for everyone? So you can put a simple yes or no answer or a it depends and explain why. Some great comments already coming through. So do higher interest rates always make life harder for everyone? In simple terms, no, because it depends on who you are. And just looking at some of the comments that are coming through, it a lot of you have said that it depends, not always or not necessarily. It depends because of who you are. If you're a borrower or if you're a saver, it depends which one you are. And that's the key idea. One decision, different effect across the whole economy. Thank you for your time this morning and contributing to that discussion. I'd like to hand you over now to Beth, who will talk a bit about her experience about becoming an economist and her work with the Welsh Government. Thank you.
Thank you. Yeah, hi everyone. I'm Beth, and I'm just going to give a quick overview on what I do as an economist and my path to getting here. So, I'm currently an economist, an economic analyst in the Welsh Government, and my current role is in the Rural Affairs Directorate as a policy economist. And I primarily work on providing evidence and assessing the value for money, and for mainly for agricultural policies such as the Sustainable Farming Scheme. And in terms of my path to get here, thinking back to school, I didn't really know what I wanted to do for a career. I enjoyed most subjects, but I didn't really have a favourite one until I started studying economics at A level. And when I chose it at A level, I didn't actually know what economics was or what I'd be learning. And I still remember my first lesson, and the teacher put up a PowerPoint titled, "What is Economics?" And as we went through it, I remember thinking that this is exactly the sort of thing that I've always wondered about and actually wanted to learn about. And it felt like someone was finally explaining all the big things that you hear about in the news, such as inflation, the budget, interest rates, but in a way that actually made sense. And it felt like the only subject that was actually about real life and how the world works, which I really enjoyed. And I think that's still what I love about economics now. I like being able to explain to friends why things like the war on the other side of the world can affect their petrol prices or their mortgage rates. And I like understanding the mechanisms behind all of it. So yeah, after school, I chose to study economics at Newcastle Uni, and towards my third year, my friends on my course started securing grad schemes in like banking and consultancy roles. But I graduated not knowing exactly what area of economics I wanted to pursue. The course I was studying at Newcastle was very maths heavy, and I knew that I preferred the applied economics side of things, but didn't really know how to translate that into a career. But then I ended up graduating in 2020 in the middle of the first lockdown, or just towards the end of the first lockdown, which was obviously a bit of a weird time to try and figure out next steps. And I actually got my first job in Welsh Government, but it wasn't related to economics. I was working for the Minister for Rural Affairs, but in her private office. So I was basically helping the minister with her emails, her briefings, her meetings, helping her send letters. And I was effectively on the other side of the analysis that I do now. So I was the one helping get policy advice and analysis to the minister rather than the one doing it. But this exposure to the analysis that the minister received made me want to be on the other side of it and use my economics degree. So I applied for the Government Economic Service Assistant Economist Scheme, I think it was called, and I was assigned to a role in the ONS, so the Office for National Statistics. And I was there for a year or two, working in the global trade and investment division, which was a really good experience. And it was quite a mathsy role again. I learned how to code and handle large data sets. But again, I knew I was more interested in the policy side of things, and there wasn't a huge amount of exposure in ONS for that. So from there, I moved to the Department for Culture, Media and Sport, where I supported a civil society and youth policy team as an economist. And I also moved to London for that job, which was a really good experience. And yeah, this role was much more policy focused than the role that I had in the ONS. And I learned how to do cost benefit analysis as a policy economist, which meant I gained the skills to assess the value for money of policy schemes through appraisal and evaluation. And I think having these skills helped me secure the job that I'm in now, which is back to the Welsh Government as an economist for policy in rural affairs. So it's very much a full circle moment back to my first job where I worked for the Minister for Rural Affairs. But now I'm on the side where I'm producing the analysis and the briefings to the minister, like I set out to do. So yeah, that's the path to where I am now. And yeah, very happy to answer any more specific questions separately about what I do. But for now, I'll pass on to Sam, and he's going to talk about the Young Economist of the Year competition.
Hi, I'm just going to take over because Sam can't make it. But I'm Anisha from Discover Economics, and I'm just going to tell you a bit more about our competition. So we have our annual competition, which is the Young Economist of the Year competition, and it basically gives you a platform to tackle some like real world questions and current affairs. So our competition is currently live. I will be putting the link in the chat so you can have all of the information about it. But basically, the competition is aimed at year 10 to year 13. And there are 5 questions. So you get to choose from 5 questions, and all very relevant to what is happening in the world right now. And this is basically your opportunity to tell us, what are your views? What do you think we should do? What solutions? Just your arguments. And we really want to hear about you. So you can enter the competition in any format you want. There is a podcast, an essay. You can write like a blog. You can also do a video entry. So we really want it to be accessible, and we really want you to be able to be creative with it and have fun with it, and just like share your ideas and opinions in the best way that you can. You can enter as an individual, or you can enter as a group. It's completely up to you. So if you want to partner up with people from your class or even other schools, that is highly encouraged. And at the end of it all, you submit your entries, and we will shortlist the top entries from each category. And those participants will be invited to KPMG, where our final will be held. And after that, the winner is decided, and you will have the opportunity to be published in the Financial Times, which is quite exciting. So if that sounds interesting to you and you want more details about it, then just click the link in the chat and you can look at all the rules and how to enter our competition. Thanks. I'm going to pass it over to Rian.
Diolch yn fawr. Thank you very much, Anisha, and for that introduction to the Young Economist of the Year competition, which has launched today. And I believe the link, Anisha, you're going to put the link in the chat for all the participants today. A big thank you to Beth for giving us a flavour of your journey from the classroom and A-level economics to where you are today as an economist in the Welsh Government. And last but not least, to Dr. Edward Jones for a very interesting and I found very easy to understand presentation on interest rates. So diolch yn fawr, thank you very much. That's it for today. Our next webinar will be next month, again hosted by Bangor University. So our big thanks to Discovery Economics and Bangor University and our young economists in Welsh Government for providing this opportunity. Diolch yn fawr. Bye all.